Welcome to the Radix Review. Tune in each week as co-hosts Jay Denton and Chris Nebenzal cover the key trends in the apartment industry, macroeconomy, and much more. And welcome. Today is June 12th. I'm Chris Nebenzal. Jay, what are we seeing in the market today?
Chris, we're going to just lightly cover on multifamily today because there have been a few economic and labor market reports or announcements since our last recording. Thought we'd spend a little bit more time on those because they're obviously very influential to multifamily. So the latest jobs report, we'll cover that. This morning, a new reading on inflation was released. You'll give us some of those details. Right on the heels of that, the Fed came out with their latest decision as to raise interest rates or not. I'll give you a preview. They did not. So we'll talk about maybe what that means and expectations for the rest of the year. And our wild card might be my favorite one to date. We're going to talk about summer jobs. Since we're talking about jobs reports, we're talking about jobs we had in the summer as kids. So let's go ahead and get it started. If you would like to give us just a little bit of highlight of the latest multifamily numbers that we've seen.
Absolutely. So we didn't really see huge changes in the multifamily market last week. For the most part, the leading indicators have flatlined. Traffic at the national level actually slowed a little bit, but that's normal this time of year. The traffic and leasing numbers will start to slow. Rent and occupancy will continue to pick up as they have likely for another 4 to 6 weeks before they kind of plateau and flatline for the rest of the summer and into the fall. Occupancy is slowly creeping back to that 94% level. But mostly it was a quiet week nationwide last week. A couple markets that stood out specifically in the Mid-Atlantic. Virginia Beach continues to do strongly. Washington, D.C. is doing well. Our market of the month, Wilmington, North Carolina, continued with another strong week. And Memphis, Tennessee actually had a pretty good week, all things considered, across the board in multifamily last week. So some of those smaller southeastern markets, mid-Atlantic markets were the ones that outperformed, but mostly a flat week across the multifamily industry.
Okay, well, that's a great recap on multifamily. I think if we then turn on to what we're seeing on the jobs front. So last week I talked about the prediction. If you asked economists, what was their thought on what the job reading would be for the month of May? Consensus was around 180, 185, 190 in that range. The number actually turned out to be much stronger than anticipated. 272,000 jobs were added in the month of May, according to the latest Bureau of Labor Statistics report. Now, to put that into context, especially as it relates to multifamily, so we're talking, roughly an extra 80,000 or so jobs added. If you take that old number, and I don't know what the number is today, but if you take the old number of, hey, for every 5 jobs added, that would fill 1 extra apartment unit in the market. So if you just take by how much extra the market outperformed with an extra 80 or so thousand jobs, so you're talking about 16,000 extra apartment units absorbed just by the overperformance. So that's like the number of new units delivered in one of fairly larger size market like a Denver or a DC or an Atlanta. So great news. Let's hope the number stays actually at that rate. We've seen a little bit of downward revisions lately.
Yeah, I think that's a great point, Jay. And I saw in the press release that you put out this morning, a lot of the job growth seems to be supporting that stable occupancy, especially given all the supply. Can you talk a little bit more about kind of the perhaps the positive news that stable occupancy is?
Yeah, in terms of just how it's been at least steady, I guess you would say.
Yeah, exactly. Because we've been up against this generational supply wave, but perhaps tell us more about how the jobs numbers have bolstered up that occupancy number.
Yeah, well, I think when supply is one of those things that you see coming for a long ways away. So we could see that this year was going to be tough from a supply perspective for quite a while. Heading into the year, what's more of a wild card is what's going to happen in the labor market, what's going to happen in the economy. And so for occupancy rates really just even to stay stable, we needed a pretty strong labor market this year. And honestly, that was not the baseline. The baseline was likely going to be softer growth, perhaps negative job growth. And that's not what's played out so far. And so it's actually been pretty strong, pretty stable. We've seen a little bit slower growth than where the year began, but all in all, it's been a strong job market. So to me, when we look at the occupancy rate, which has been floating just below 94% all year, that's actually very, very positive news. Now, we would all in the industry love to see it, a few ticks higher than that, closer to 94 and a half, maybe even some places 95. But it just shows the resilience of the labor market. It keeps going, and thankfully, because of all this supply wave that's happened, I think, as you've mentioned, we've only got 4 to 6 more weeks left of really, prime leasing season, when you'll see, traffic still at elevated levels and so on. So we're really going to almost start turning our attention to 2025 soon. And that's the real question to me. Is we know, again, we can see that supply is coming down. If job growth could even hang around where it was last month, like in the 170K range per month, I think the apartment market will be fine. We'll still see solid performance. And in fact, next year we could see a lot of other places improving.
Absolutely. That makes a ton of sense. Thanks.
Yeah. And, beyond just the headline number, I would say, we talked about this, seems like all the time. Every time we talk about job growth, the layer I like to peel back would be back to types of jobs added. And I think it's also important to the question you just asked around occupancy, but I would say particularly absorption for new supply, and the types of jobs added. New supply, by definition, for the most part, unless it's purely built as affordable housing, it's going to be built towards the top of the market just because of economics. It has to be to justify the cost. It's not like developers are necessarily picking, to price something at the top of the market. It's just the cost of land and construction and so on, and the investment dollars that, for people who are investing in the construction itself. And so, if you look at the types of jobs added, they're not necessarily all at the top of the market in terms of pay that could afford that type of construction. Recently, we've seen a lot of jobs added, specifically in leisure and hospitality, government, neither of which are necessarily towards the upper part of the pay range. Healthcare has been really dominating. And again, if you take those three combined together, those three accounted for more than half of the jobs created in the month of May. And that's been a pretty typical type thing that we've seen. Healthcare, a little bit higher pay than the other two that I mentioned. But for this month, I thought what was great, where we've been talking about, gosh, it would be great to see some diversification in types of jobs added. There's a industry, so not like your major industries, but your ones right below it. So within professional and business services, within that one, there's a subset called professional, scientific, and tech. And that's what has a lot of your like accounting jobs, legal jobs, your tech, computer design, scientific research. Those are all contained in that one sector. That sector added 32,000 jobs. It was one of the most, like, not just industries, but of anything, it was one of the highest job gains for the month. So if we could see that continue, it would be great news for new supply. On average, those types of jobs pay right around 100,000. That's average. You take some of those specific types of jobs, even closer to entry level, your tech jobs, your legal jobs, you're talking well into the 6-figure range. And so for that new supply, I think that's another great little really slice out of the jobs report that I saw when it came out. Overall, wage growth, positive, I would say, for those looking for rent growth, not as much for maybe managers who are trying to keep their budgets under control for their departments. Wage growth ticked up a little bit. It was 4.1% for the month. It was expected to be at 3.9. I would say wage growth overall running a little bit hotter this year than what was anticipated. Good news for rent growth, potentially, especially from a longer term basis. Maybe not as good a news for something we'll talk about in a minute with inflation and perhaps as it relates to some of the Fed's decisions. Last thing I'll touch on, latest jobs report, unemployment rate, it ticked up very, very slightly to 4%. While the number moved up, again, consider that by long-term standards, that's still a very low rate. And for any of you who are hiring managers out there and you're like, it doesn't seem like there's that much supply of talent, specifically for the types of roles that I'm looking for, you're right. Management jobs, tech jobs, legal jobs, healthcare practitioners, all of those have unemployment rates of 2.5% or less. So one of the reasons I think that we haven't seen as much new net job creation in some of those higher paying jobs, the unemployment rate is actually still pretty low. And so it's hard to add a lot more jobs if you don't have the people to actually fill them. So that's the latest, I would say, on the jobs report. I know that was a whole lot there. That's one of the indicators the Fed looks at among several. Another would be the inflation report. Chris, I know you dug into the new CPI numbers that were released this morning. Curious of some of your findings there.
Yeah, and Jay Powell in his press conference this afternoon continued to harp on not just inflation but the dual mandate of the Fed, which is unemployment or the strength of the employment market as well as stable prices. So, Jay, great coverage on the employment side. What are we seeing in inflation? The CPI numbers came out today, as you mentioned. On an annual basis, CPI grew 3.3%, down ever so slightly from 3.4%. Now, is that a huge change? No. But drilling a little bit deeper at the core CPI or the CPI that strips out volatile food and energy, that had the smallest gain since April of 2021. So obviously, remembering back to April of 2021, we've seen tremendous inflation since then. So the fact that we're down to kind of early pandemic or mid pandemic levels before inflation started running really, really hot, that's good news. Now, with that good news, it wasn't, I'd say, excellent news, at least not in terms of the Fed movement. As you mentioned, they did not cut rates. No one was expecting them to cut rates, but perhaps more importantly, they gave their projections for the rest of the year. And we'll break down some of the numbers here in just a second. But at the headline level, most people now expect one rate cut through the remainder of 2024. Now, if we go back 4, 5, 6 months at the beginning of the year, some people were looking at 6 rate cuts. Some people were looking at 4 rate cuts. Obviously, we've seen inflation stay persistently high in 2024. We're not going to get a number of rate cuts. 2 would really be a huge stretch. In fact, only 8 of the 19 FOMC members expect 2 rate cuts this year. 11 of the FOMC members expect 1 rate cut this year. And 4 actually said, no, we don't think we should cut rates at all, given where inflation is, given where the employment market is. So it's a relatively mixed bag. Again, it's not a huge disagreement or a huge disparity among the FOMC members, but there is some slight disagreement in terms of where we should take monetary policy over the next year. Now, interestingly enough, they also released their 2025 year-end and 2026 year-end expectations. As any forecaster knows, ourselves included, the further you get out, the tougher it is to forecast. And so these numbers are certainly subject to change. But what the Fed is anticipating as of today is for 4 rate cuts next year. They expect 2025 to end the year with a Fed funds target rate of 4.1%, 4 more rate cuts in 2026. They expect the Fed funds target rate to be at 3.1% in about 2.5 years. So they do see some positive momentum in terms of inflation. Inflation has been coming down. Jerome Powell in his press conference continued to quote the PCE. That's their preferred measure of inflation, not just CPI. And PCE is in the 2.7, 2.8 range. But again, it's just a little bit higher than they expect. So no direct action from the Fed today. No action was expected. But with that said, the market still reacted pretty strongly. Treasury rates were down about 10 to 12 basis points across the yield curve. The 10-year Treasury was down as low as 4.25. So the market sentiment does seem to see this as a positive advance. CPI slowing down, even if that slowdown is in itself slow, and then the Fed eventually moving toward a rate cut, likely at the September or the November meeting. So again, good news, I would say, from CPI, from inflation, steady news from the Fed. Powell certainly used his favorite line that says we're going to continue to be data dependent. If the employment market weakens more than we expect it, they could cut rates sooner. If inflation comes down faster than they expect it, they could cut rates sooner. But again, with all the information present in the market today, the Fed's looking at about 1 rate cut for the rest of the year.
Yeah, that's that's unfortunate for that mortgage rate that I signed up for back in February, because expectations were much different. If you haven't tuned in to one of our recent podcasts or one of our webinars throughout the year, I've often highlighted that I purchased a home in February, and part of, not necessarily part of the decision, but when I was thinking about it at the time, interest rates were 6.6%. They actually went up from there, but mortgage rates were. If we think about where interest rates, the federal funds rate was headed according to economists, I went back again and looked at the Wall Street Journal survey of economists over the last two. So in January, when these 60 to 70 plus economists were surveyed, they thought that by this meeting, so the meeting that just happened this week, 86% of the economists surveyed thought we would have at least one rate cut by now. So that's within half a year how much things have changed. So from then to now, 86% thought. When the same economists were asked in April, so just a couple months ago, what would happen? 54%, so half of them still thought in April that we would have a rate cut by now. Now we're talking about maybe one this year. And as you've mentioned, a percentage of the FOMC members are thinking that maybe we won't have one. For those who don't follow the specific schedule all that closely, there are 4 meetings left this year. There's one in July, September, November, and December. And so you do start running out of time as to how many could happen at any point. And then there's the election that's thrown into the mix, and trying not to have any sort of political sway with any decisions that are made there. The final point I guess I'll make, and see any thoughts you have to wrap it up, Chris, would be, it is an interesting position, obviously, that the Fed is in when they're thinking about balancing. At some point, holding interest rates higher for longer will start to impact certain businesses that are vulnerable, whether it be banks or just other businesses that are out there. While at the same time, we are already still maintaining a pretty hot labor market. I've already mentioned the wage growth, job growth running still hotter than most people thought it would. And so that balance of what do you do with some of the different indicators that are at different spots and maybe where they would prefer before they start making rate cuts.
Yeah, great point. And so I've been wrong a number of times this year, so I'm going to put my crystal ball away on the shelf. My crystal ball is about as murky and dirty as that kind of bluish brownish bowling ball that's far on the last rack. But you tell me, look in your crystal ball, when are we going to see that rate cut? Is it going to be September? Are they going to run the risk of looking political and moving in November? Are they going to push it all the way to the end of the year and roll it out in December?
When you think about those dates, there's only one more report between now and July. And so I have a hard time believing if they didn't see enough already, I don't think the numbers can change enough between now and July. So the first possible, they have 3 more readings between now and the September meeting. I think that's the first realistic one, I think. And then you run the risk of getting towards the really back part into the year. So September, November, I guess would probably be where I would target, unless they just don't want it to be part of anything to do with the election, if that's even part of their equation or not. And then you would be looking. I would think, though, if the numbers continue where they are are steady, maybe tick down a little bit. I would still think I think the majority of the voting members that at least one would happen before the end of the year.
Absolutely. And just thinking of the impacts on the multifamily industry, we know that there's a lot of maturing debt coming due this year. 3 years after 2021, there was a lot of mortgages originated in 2021 with 3-year interest-only time periods, and then either interest rates picked up significantly or those loans would need to be refinanced. So with each passing month, with each passing meeting and no movement, this is making it more and more expensive, harder for property owners to maintain those properties, and valuations are staying depressed from what I've talked to with our clients, with brokers, with people in the industry. So even though we're not here to kind of root for one side or the other, as we look forward to that first rate cut, perhaps even more meaningful, those 4 potential rate cuts next year, that's going to open up, in my mind, a lot of liquidity for the multifamily industry. It's going to bring things even more back to normal on the transaction side. You and I have talked a lot about the return to normal from an operations perspective, and I'm glad that we are now returning to more of a normal period for operations. We're still not out of the woods on the transaction side. And so as monetary policy eases, as rates come down even a little bit, even 25 basis points, 50 basis points, 1%, we should see that liquidity open up a little bit more on the transaction side, which would greatly impact our clients and anyone in the multifamily ownership side.
Okay, well, you want to wrap up now with our wild card?
Let's do it.
Okay, well, I'll ask you first and I'll wrap up with my answer. So again, with the job market being a big topic in today's discussion, we're into summer. I have teenagers looking at either have jobs or getting jobs. And so it reminded me some nostalgia. If you think back, Chris, any jobs you had maybe as a teenager in high school or as a young adult that if you want to highlight a best, a worst, or maybe both, where's your brain at on that?
Yeah, it's we're rolling into summer, so thinking about summer jobs from days gone by. I unfortunately don't know that either of these jobs would have qualified to be in the BLS reports, but my first jobs were mowing lawns in my neighborhood and caddying at a local golf course. Everything was cash based, so I don't think it was recorded, but they were great. I love doing those in the summer. Being outside, if there was a way I could do my job today from a desk outside, I would probably go for it. Just being outside in the summertime, you can't beat it. And then perhaps the next best job I had was an internship with Morgan Stanley in the summer of 2008. It was a wild time to be introduced to the financial markets. It was an action-packed period, obviously, in the economy and what was going on Wall Street, but it was a really eye-opening experience. 180-degree difference from mowing lawns and carrying golf bags, but another really, really cool job and gave me kind of my first foray into business, first foray into finance. I got to take the train downtown every day, put a suit on, and it was another good one. So yeah, looking back on the summer jobs, I've got nothing but fond memories. How about yourself, Jay?
I would say first, those are some great ones all the way around. I'm quite jealous of the golf club one, but the financial one, like that point in time, having that job, pretty neat intro there. So I would say the best was the summer I was 16. I just turned 16. Very similar thing. A friend of mine, he had a truck with a trailer that he could put lawnmowers on, and so we mowed lawns that summer. We didn't really have many clients. So the only reason I was doing any of this is because my mom was like, you need to go get an actual job, not just play sports all summer. And so I'm like, we've got one. We have a landscaping company. And I think we had like 3 clients probably total. But grass grows fast in Texas, so I keep us busy a couple afternoons per week. But it was at a private lake, and so I think we spent more time swimming than we did working. Didn't make any money, but had a whole lot of fun. So my mom caught on to that ruse, which made the summer of 17 a lot different, which was probably the most challenging or worst job I would say that I had specifically as a teenager. So unfortunately for me, my stepfather was a manager at a manufacturing warehouse that had no air conditioning and required me, I think, to be at the job at like 6 a.m. Maybe it was 7. It felt really early. And it was, 25 minutes away. So I had to get up, eat, get ready, drive all the way out there at a time that I didn't even know existed at that point in life. It was hot as can be through the summer. The plant produced fiberglass parts for 18-wheelers. And my job was to sand down these fiberglass parts, in those conditions. And honestly, while it was tough, it gave me a completely different appreciation for what real work was. And just that summer and everything that I did there, I would then leave there and then go, I played baseball a ton when I was a kid. So I played baseball afternoon, essentially got no sleep all summer and would just roll out and go there the next day. So that was the toughest. And then the most interesting was probably around, more like your topic. It was my first internship right out of high school. I worked for a company that manufactured, in fact, my job was part of this, manufactured silicone wafers that became computer chips. And so my job was to run this huge machine that cleaned the wafers. It was an overnight job. So again, another learning lesson and appreciation for what it takes to make this, and what people do, in different parts of life than you might ever know. So I got just different exposure than normally I would have. And so that was pretty interesting to see how those are made and actually be part of the process.
Absolutely. A wide-ranging career set to begin with, for sure. All right, Jay. Well, thanks for joining today. Today has been a good podcast. We had quite the day on the economic front, even if it was a lighter week in multifamily. But thanks to all for joining us, and tune in next week for more details on the multifamily industry. We may even be live from NAA next week. Thanks, everybody.